of all. Now second step is that you will continue to build on this income statement. How will you do that? So you will start with the top line. So you have put in the past data of sales in your sheet. Now next step is that you need to forecast sales. So first item in your income statement is sales. So that means first you need to forecast sales. In order for you to forecast sales, you need to know that how are these sales formed? What lies behind these sales? What is driving these sales? What is the geographical mix? What is the pricing? What is the volume? How are these sales being formed? Because until and unless you know that, you will not be able to forecast future sales, correct? So that means first you need to know the breakup of these sales. And where do you find the breakup? Breakup is found in notes. So you open the annual report again and you go into the notes to find out the breakup of these specific items. So let me open the annual report for you so that we have it. Okay, so this is the annual report for Procter and Gamble, which I have downloaded from Investor Relations website for 2016. So in this annual report, I can find out all the breakups, that what is the geographical split of sales. So for example, this show what has been the sales trends and all that. If you look into this, it gives you sales by the segment, and it also gives you the sales by geographic region. So means that your sales growth for future or sales forecast for future will be dependent on all these regions. If one of these regions go up, then your sales will increase. If there is a crisis in one of these regions, then your sale will decrease. So your sale is formed by the breakup of all these regions, or through all these, by combining all these regions. That is one thing to know. Second is that when I go further into maybe notes to financial statements, profit and loss. Okay. So this is the income statement. So in this income statement, you have sales just appearing as it is. Now, if you want to see further breakup, that where is the sales coming from, what you need to do is you need to read through all the details that are there in the in your uh, annual reports. In those details, we can find out percentage sales by business region, the business unit, that how much is fabric care, how much is baby care, how much is hair care, how much is shave care, family care, oral care, skin care. And secondly, we can also find out the geographic split that we did at the start. In addition to that, we can also find out any large customers to which sales are being made. So if you look into it, all this segment is segment information. And in segment information, you can find out that what is happening in different segments, what is the size, is the size increasing, is the size decreasing, and is the who are the largest customers. So in this step or in this stage, you only find out how are the sales being formed. Secondly, when you form the sales, sales has three components primarily. One component would be volume growth. How is sale formed? Total revenue is sales into volume into quantity, price into quantity. So that means there is a component of volume, which is quantity, and there is a component of price. And when you combine this, that would make your total growth. Secondly, as it is an MNC also has another component in its top line, which is known as forex changes. So for example, if let's say this is PNG, and let's say PNG sells something in Pakistan. So if PNG is selling something in Pakistan, its price would be in rupees, or its price would be in PKR. But for reporting purposes, PG would be converting this PKR to USD dollars. So if PKR to dollar rate changes, then that means its revenue will also change. So some of the currency impact would also change the revenue, would also impact the, any currency changes would also impact the top line. So that means if I have to forecast the future sales of the business or of this business, I need to forecast volume and I need to forecast price, and I also need to have some view over conversion. Generally, this FX is not in control of the company. So if until and unless you know something that is going to happen in future, otherwise you take it as stable, or you take it based on the past trends, or you expect that eventually economies will reach stabilization and eventually it will be stable out. But volume and prices are much more critical. So how do you forecast volume? Now the question is that had it been a simple company, like for example, had it been only Procter & Gamble Pakistan, then volume forecast would have been easier. I would have just looked at the Pakistan's forecasted GDP, or Pakistan's forecasted grocery sales, or Pakistan's forecasted soap sales, or whatever. That is easily available through third-party research agencies. Or if nothing else, then I know that Procter & Gamble has a strong association with GDP. If GDP grows, its revenues will grow. Why? Because it is selling consumer products, and consumer products are directly linked to GDP. So as it is a consumer staples producer or selling consumer staples, its growth will follow the GDP growth. So had it only been Pakistan, I would have forecasted Pakistan's GDP and used it as forecasted volume growth for PNG. But the question here is, or the challenge is, that there are different countries or regions in which it is operating. So what am I going to do? I will have to forecast volume separately for each region, because until and unless I do that, I will not be able to have a good view or correct view on the overall revenue forecast. So that means I will have to forecast volume by region, and that is not enough even. I will have to forecast price for every region separately as well. Why? Because pricing in every region would be different. Maybe there is high inflation in one region, maybe there is lower inflation in another region. So that means I will have to forecast price for every region separately as well. Any problem so far? And how do I find out regional split? I have found it from the annual report. How do I find out past volume growth or price growth? I can find that also out from annual report, but I wouldn't have volume and pricing growth for individual regions. Volume and pricing growth would be here. So if I have to look at volume, it tells me organic sales increased 1%, as increase in pricing was partially offset by a reduction in organic volume. Organic sales means the mix of volume and pricing. So there is pricing, there is volume, and if you combine the impact of pricing and volume, that becomes your organic sales. Means just excluding your forex impact. But then again, there is another component which goes into organic sales, which means that volume and pricing can further be broken down into another component, which is known as product mix. So for any company, let it be P&G or any company, if it is selling a product, then it is usually not selling a single product, it is selling multiple products, and each product has different profitability and different pricing and different growth. So if the mix changes, the growth will change. How? So for example, let's say that there is a company which sells 3 products, one for $100, another for $90, and third one for $80. Let's say it went up 5%, it grew 4%, and it also grew 4%. So overall company's growth rate would be somewhere in between 4% and 5%. Now if I tell you that next year this category grew 6%, company was more focused on this category, so it grew 6%. And these two categories grew an even higher 7% and 7%. So it looks like that on the face of it, it looks like that maybe overall growth should be very high. Or in another scenario, if I say that this grew 5%, but this grew let's say 4.5% and 4%. So if I know about one category, that this category is growing at 4.5%, that cannot be applied to all the categories pricing. Or if I say that prices in this product category increased 4.5%, that cannot be applied to all the other categories. That means total wouldn't be consistent. Total would depend on mix as well. So if I have started selling more of something which is cheaper, then my total growth will suffer, or my total pricing will suffer. If I have started selling something which is more of something which is expensive, then my overall growth will be positive. So that means only pricing going up or volume going up is not important. You also need to know that where is this volume going up? Is it going up here, or is it going up here, or is it going up here? Because if it goes up for lower value products, then overall sales growth would be a bit lower. But if it goes up for higher pricing products, then overall sales growth will have a positive impact. That means only pricing and volume are not enough. There is also another factor which is mix, which is product mix. It can be product mix, it can be geographical mix as well, because prices in different regions can be different. But then again, major ones would be volume and price. It will be difficult to forecast mix, and it will also be difficult to have a view on mix, because you never know what company is going to sell next. But you can have a view on it based on the past. So you can check whether over past companies' focus has been on high value products or low value products, and based on that you can forecast mix. So that means in order for you to arrive at organic growth, you need to know price increase, you need to know volume increase, and you need to know mix. Mix would be dependent on company's strategy and company's business. Volume would depend on GDP growth, and pricing would depend on inflation. But challenge is that there are different regions, so you need to have different volume for different region, different pricing for different region, and product mix then as a whole. And then FX. So up till now what you are doing is that you are trying to decode the sales, that where are sales coming from. So you can decode it using geography, you can decode it using product category, you can decode it using price, volume, mix, and FX impact. And the best way is when you are decoding it, go to annual reports and see how company has broken it down. So if you look into it, company breaks it down in pricing, company breaks it down in volume, company breaks it down in mix, and company breaks it down in foreign exchange, and company breaks it down in geography. So if I have to see organic growth, so if you look into it again and again, they would be focusing on organic growth. Why organic growth? Because this is the true measure of performance, because FX is not in the control of the management. And if you go ahead again, you will find mix as well. That what is the impact of mix? So favorable product mix impact of 1%, what offset by acquisition and all that, and you can find out here as well that how much is mix. So you will be able to break down your sales into price, sales into volume, and sales into mix. So you can find out how much was due to mix, how much was due to price, and how much was due to volume. So if you look into it, volume with acquisitions and divestitures, volume excluding acquisition and divestitures, foreign exchange, price, mix, other, net sales growth. So you also know that how much is coming in from acquisition. Why? Because if a company acquires something, acquires a new business, it gets added as a volume or as a sales as sales to the company's business, but that is not sustainable. Why? Because that growth came in because company acquired the business. Now next year it will be in baseline, so that growth wouldn't come in again. So when you are forecasting, your focus is on volume excluding acquisition and divestiture, price, mix. Any confusion so far? Yes. It wouldn't tell you the units, it will tell you the growth, that how much has growth been in terms of volume. Yes, exact number. Some companies may report exact units as well, that is even better, but here it is not available. So in order to forecast, when you forecast, you need a growth rate. You have current sales, you need a growth rate to forecast future sales. So in that scenario, in order to arrive at that growth rate would have volume growth, would have pricing growth, would have mix. So that means you need to have volume growth. As long as you have a growth rate, that should suffice, even if you do not have units.
So over here it is telling us that after the acquisitions, the growth was
Acquisition and divestiture. So it can either be acquisition or it can be a disposal.
So there is
divestiture.
a bad picture after the disposal.
Yes, because they disposed of. So if you sell a business, your overall revenue will decline. But that doesn't mean that company has performed badly. That only means that you have separated a business or you have sold off a business. So that is, so when you are forecasting, you wouldn't look at this volume growth. You would look at volume excluding acquisition and divestiture. And if you look into it, volume is low. Why? Because pricing is high. So generally in any environment when prices are going up very high, then volume is declining. So key points are that you need to break it down as per annual report data or as per your analysis. So we have decided we will look at volume, price, because multiplying these two will get you revenue, and we will look at additional factors like mix and foreign exchange. When performing valuation, remember another key thing, that keep focused on those items which are expected to have bigger impact on value. And if there is very immaterial thing, or if there is something which it is not expected to impact value much, then do not invest a lot of time into it. So this means we need to make another sheet in which we do all this backup working. That sheet is IS notes, income statement notes. So here you can break down the sales or sales growth into different segments. So like you look into, if you look here, I have taken volume, pricing, mix and other. That makes organic growth, and then acquisitions and FX impact, which makes total another growth. Any confusion so far? So this is my current picture, 15 and 16. Now next step is that I need to forecast it for future, because in order to arrive at total sales growth, this is the total sales growth, organic sales growth, and this is the net sales growth. In order to arrive here, I need to have a forecast of all these percentages. So starting with first one, I need to forecast volume. Before I forecast volume, I need to know that what is the volume forecast. Volume forecast is simply GDP forecast, right? So you can take real GDP forecast as a proxy for volume forecast, assuming that company will grow at the rate at which economy is growing. It is not a high growth company, so it will not grow at a higher rate than economy until and unless there are any significant changes. It is not a perpetual company. I mean, it does not have perpetual revenues, which means its revenue will continue to grow at a specific slow rate. And what is that rate? That rate is the macroeconomic growth. As economy grows, company will also grow. Yes.
The GDP would vary from economy to economy.
Yes.
So will we break our analysis into country-wise analysis?
We should break it on the broader level which is available. If you want, you can go to country level as well, but then there is a problem that do you have company's data available at company level? If you have that, then you can go for country level. Secondly, even if you go at country level and then you combine it to form that region level, there wouldn't be much of a difference. So do you really want to put that much effort in going to country level and getting the forecast for each country? Thirdly, another question to ask when deciding it is that if you have country level GDP forecast, will that be as accurate as having a regional level forecast? Because regional level forecast would be covered by economists who are sitting in maybe World Bank, who are sitting in maybe IMF, or globally monitoring, who are looking at global economies. While country forecast would be dependent on that particular country's forecast. So if there are 70 countries or 80 countries, if I am forecasting GDP for each country, there are chances that that forecast might not be accurate. Instead, having a regional level forecast would be accurate. Now the question is that where do I form the cut? How many regions? So I will take as many regions as being reported by the company. So company has reported some data on regions, that what are the regional sales or region wise sales. So I can pick up that data and based on that I can forecast the volume. Yes.
Just one question. You said that we can take real GDP, right?
Yes.
Earlier in pricing, you mentioned that inflation can play a role for pricing.
Exactly.
So why aren't we taking nominal
Real GDP will give you the volume. So we will forecast volume based on real GDP, and we will add inflation at pricing. So eventually it will become nearer to nominal GDP. So real GDP means GDP excluding the pricing impact, which will come in volume, with which we will forecast volume, because volume or quantity is related to real GDP. So that means now I need to have the split of regions. And how do I have the split? I have it through annual reports, which we just fact. So this was the second sheet which we had opened. Now let's open third one. So I have broken it down into different steps so that it becomes clear that what step are we actually taking. Right. So if you look into it, and I have broken down sales or sales growth into different regions. So I know that 44% come from North America, 23 Europe, and this should sum up to 100. Sometimes you may not have exact region, and company may state that rest of the remaining portion comes from rest of the world. In that case, that would be a small portion. You can take it from rest of the world. So you know where is the revenue coming from. Now second step is that I need to forecast this. When I forecast this, I need to know its forecast. That means there are some assumptions involved, and that means there is some historical data required, which means I need to make another sheet which is known as assumptions, because all your assumptions should flow in from one sheet, so that I do not need to go in here and then change the assumption. I should have one base sheet as assumption. So if you look into it, on face of income statement, you only have one number. Its breakup is in notes. Within notes, forecast is dependent on assumptions sheet. So this is how model is linked, so that if you change anything in assumption, then income statement should change or your value should change. So in assumption sheet, I have made, when I am making assumption, I will be making many assumptions. There will be macroeconomic, there will be profitability, there will be cost, there will be debtor days, working capital, capex, multiple assumptions that you will be making. So that means I need to make sections. So I have made one section for first section for macroeconomic assumption. Here I will be putting macroeconomic assumption. So if you look into it, I have put in historical GDP growth rates, real GDP growth rates of these regions, and the forecasted GDP growth rate of these regions. Now the question is that how do you get it? So historic are public. You can find it from World Bank, you can find it from IMF, you can find it from multiple sources. So if you just Google it and find it out, you can easily find out the historic ones, that is 2016 here. Now the question is, how do I get the forecast 17 and 18? So there are certain global economic reports which are issued which contain forecasts for all these regions. So for example, there is a report of economic outlook. So you can take economic outlook 2017 report or 2016 report, that will give you the forecast for next 2 years. There is an economic outlook report for so for example, if you are doing it in 2018, there will be a World Economic Outlook 2018 report or 2019 report. You can find out forecast for next 2-3 years in that report. So there will be certain data which is used.
So in the economic outlook report for 2016, we will be able to figure out the growth rates or the rates for 2017 and 18.
Yes.
For the future years.
For future years, you will have a forecast in World Economic Outlook or this is just one report. There are multiple reports. So maybe Morgan Stanley does its analysis. There are different banks which do their analysis. So in those analyses, you will find out the global trends. So all the global trends will be present here. So if I look into it, I can probably find economic growth here. So for example, North America. So not only this, but there will be different or many analyses. So this can tell you about its specific areas. This can tell you about its specific real GDP. So this is 15, this is 16 and 17 forecast projections. This can tell you about inflation. This can tell you, and so this global economic outlook report or world economic outlook report, it contains pretty much everything about the economic forecast or economic changes. So you can easily find out the forecast at regional level, and this forecast is very authentic because the economists that you have are the economists from big organizations or large banks.
Source file
Sorry.
source file इस file से मैं North America का data ले रहा हूँ. South America
So it can be different as well. So multiple times it will be different. Why? Because at times you know something that this report came in let's say January, and something has changed since January, and so you think a particular region should be taken from some other source, or maybe you think that there is another source which is giving a more accurate or more realistic number about future. So this will be your call as an analyst. So as an analyst you have the data available. Now this is your call as an analyst to decide that which is more authentic or what you think should be the future. But you have data available. The key is that you should know the source, that where should you be pulling in data from. So you will have 2-3 years of forecast. Now there can be two cases. When you are forecasting future GDP, let's say there can be a high growth market or high growth country. So for a specific country, maybe forecast for next 2 years is very high, and after that it is lower. While for a developed country, it will be same as current or past trend, or wouldn't have changed much. So based on the past trend and based on your analysis on top of it, you can have forecast beyond 2 to 3 years. You can find the estimate for next 2 years, and then based on your analysis or past trend, you can have it beyond 2 to 3 years. And how do you do that? So when we are looking at regional level or global level, generally the growth is stable. Why? Because in a particular country growth can be very high, like for example in Pakistan or in China, maybe growth is very high. But when I look at global level, global growth wouldn't be very volatile. So global growth remains be a bit stable. Why? Because if one country is going up, that country is smaller in size. Generally those countries which are smaller in size have a high growth, and so they do not contribute much to the total global growth. So after next 2 to 3 years, I have, after next 2 year forecast or 3 year forecast, I have kept it as stable, because I see the trend being stable, and I think within these regions, so a region is a broad area, so I think that within this region growth will remain be approximately stable. So I have kept these at stable. However, if there is anything happening in any region and if you want to change the forecast, then you can obviously do it as an analyst. But this is your real GDP growth forecast, and this should be put in the assumptions sheet. You can find out CAGR, but for that you will need a future number. So how will you have a future number? How will you find out growth rate? So you are saying that you want to keep one growth rate constant throughout this.
Ending value या beginning value.
Ending value है नहीं ना. So how will you get ending value? Ending value would be 2021 GDP. So you do not have 2021 GDP. You have a growth rate for it. So you need to. Past future is not the same as past. So maybe something future forecast would be different from, maybe the same, but maybe different as well. So you should rely on economists, or you should rely on third party agencies which are providing you the forecast. After beyond 2018. So beyond 2018 you can extrapolate it using CAGR of maybe 16, 17, 18. But for next 2 to 3 years, go with the forecast. After that, no one knows what happens, so you can just follow the same trend until and unless you know something would happen, or until and unless there is an obvious trend. So this will give you GDP forecast. Secondly, what is the other component that we need? Inflation, which is CPI, consumer price inflation. So I will also have inflation for all of these. So if I look into it, then again, so you can here I found the 5-year forecast of inflation, so I have used it as it is. So you can either take 5-year inflation forecast, or if you do not have 5-year inflation forecast, you can take 2-3 year whatever you have, and then forecast future based on maybe a stable trend based past. Or if you are seeing an increase in a country, maybe just increase it for next 3 years as well. If you are seeing a decline, maybe just decline it. CPI would be a mean reverting measure. So in any country, you wouldn't see inflation continuing for high inflation, high rates continuing for 20 years. You wouldn't see a low rate continuing for 20 years. There will be an increase in rate, there will be a decrease in rate. Overall, it will then stabilize over a longer period of time. So forecast will easily be available, maybe from IMF or maybe from World Bank or other sources. So you can just find it through there. Once you have CPI and once you have volume, you can forecast the individual. Yes.
Let's say, for example, I'm using a different source and let's say you are using a different source. So my only question is, would there be any uniformity in the
There wouldn't be any uniformity. So every analyst has a different value, and the reason is because expectations are different. So there wouldn't be any one way of doing performing valuation.
For example, the growth rate in GDP for North America would be 4% from my analysis, but it can be 3% from your analysis.
It can be, then my value will be different from yours.
Because the source is different.
Source is different, or what source will you will be using some global publication. So within global publications, you do not see a mismatch. So generally they are similar. If not similar, then there will be maybe among 5 agencies, maybe 3 are giving you one estimate and one is an outlier. So you can ignore the outlier and you can go with the general consensus. So there are consensus estimates, consensus forecast, and there are specific analyst or one economist or one analyst forecast. So you should go with the consensus ones. Otherwise, if you believe strongly in that particular economist or in that particular analyst who is forecasting something, then you can go with that as well. That is your view. Otherwise, generally go with the consensus or go with the averages. But every analyst would come up with a different value, because all these values will be different for everyone. This as well, yes, and also the assumptions are different for everyone. So in assumptions you have put it in, and now you will need to pull it here. So if I look into it, still continuing. Okay, so I had to forecast volume, and for volume, and my volume would depend on what? Real GDP growth. Real GDP growth of what? Individual regions. Each region would have certain proportion in company's business. So what I have done is that I have multiplied the volume with the growth rate. So if I go here, it will be, so F5 is the shortcut for go to. So whenever you have to go to any cell, F5, enter, and here it is. So 2.3%, it will pick up this 2.3% from here, multiply it with the weight that for North America, and would calculate the volume weight. Then next one, that is Europe, it will pick up the value from assumptions, multiply it here, and then so on. So it will calculate a weighted average volumetric growth. If you change anything in assumption sheet, this will change, sale will change, everything will change. So if you have to make a change, you just make a change in assumption sheet, not here. So if you have to make a change, you make the change to assumptions sheet. Any confusion? And pricing similarly for inflation. So you pick up inflation and you forecast. Any problem? For mix, if you think that company has some plans and company has shown some plans of changing mix to drive growth, then you can have something here, maybe a positive number. But otherwise, if you think that nothing will change and the company will focus on the same products with the same proportion, then you can keep it as 0. 1% states that 1% of growth came in from change in mix. That is change in your, maybe you sold some those products more which had higher price point. So even your volume grew -1%, prices increased 2%, then revenue should increase 1% only, but revenue is increasing 2%. Why? Because you sold more of those in which price increase was higher or in which prices were higher. Mix. So that is about mix. So here, if there are no plans of company, or if you think that company will not be able to drive any mix or changes in mix significantly, then you keep it as 0. Otherwise, if there are any plans and if company is focusing on changing the product mix, then you can have a some estimate built into it. So maybe you can increase it. But again, to be conservative, it is better to, in base case, it is better to go with flat, because base case is that company is already at the maturity of its product management, and so it will be much of change. Then acquisitions. So when we are doing forecasting, until and unless you know that acquisition has to be made or divestiture has to be made, value is calculated assuming no acquisition or divestitures. Then if a divestiture is made, then company will get that particular business value anyway. So here you do not need to incorporate it, you need to value the company as of today. So 0% coming in from divestiture or acquisition. FX impact. So it has been 6% and 6%. The assumption is that over time, any currency volatility actually stabilizes. So for example, if PKR has hadn't depreciated earlier for the past 5 years, then it got depreciated suddenly for all of that impact. So it depreciated about 30% over the past couple of years. Why? Because it hadn't depreciated for the previous 3 to 4 years. But now as it has depreciated 30-35%, now maybe on ongoing basis it will continue to depreciate at the stable rate, which is 5% or 6%. Similarly, any currency changes at a broader level or at global level, when we look at it at global level, the changes should move towards stability. So what assumption, until and unless you know something about it. So if you know that currency will continue to move in a particular direction, if you have that forecast, then you will take it as it is. Otherwise, you will move it towards stability. So as I look into it, I have decreased this impact by 1% every year. That this challenge will continue. Or maybe if you look into it, so if you look into it from today's point of view, maybe you find out that currencies are already stable. So maybe you find out that already this challenge has ended. So then again in forecast as well, you wouldn't have this challenge or a lower of this challenge. But this was a challenge in 16, so we have reduced it over
What
time.
about if it is completely the opposite? Like the currency hasn't been depreciated for some time.
Right. So if you expect that it will increase, US dollar against the global currencies will increase, then you need to build up an increase as well. If you think that it is coming ahead.
So like companies like PNG, they are selling in US dollar, like this
We are not
currency-
selling it. We are talking about revenue.
Yeah, I'm talking about
Yes.
revenue as well. So for example, we are consolidating the whole company level into this one, right?
Yes.
So let's say for example, the company like PNG, it is selling in US
Yes.
and it is selling in rest of the world as well.
Yes.
So in order to consolidate the foreign currency exposure, we need to calculate it will be depreciating somewhere and it will be appreciating somewhere.
Yes.
So
So
how will we basically calculate that impact?
yes. So you will need to see the overall dollar forecast. So there is an index known as US dollar index. So you can use that as benchmark so that you know that how will dollar move compared to the global currencies or currencies around the world. That is one thing. Second thing is that what you can do is you can find out. So for example, if something is happening in one country, so that you, for example, let's say you know that Pakistan's currency will depreciate 30% in next year, for example, or maybe Vietnam would depreciate, or maybe China would depreciate. So you know that there is a country which will have a significant impact on FX because it will depreciate 20 to 30%. So you can find out that how much revenue is exposed to that particular uh, currency or that particular country, and take its weight and find out that how much would it impact the total value. So, so you can then incorporate that particular countries or that particular region's impact. So it would depend on your assumption about the future or your expectation that how will it change. So you can have an increasing forecast, you can have a decreasing forecast, you can have a positive forecast. The better is, or take it towards stability. If it is positive, take it to zero or maybe reduce it over here. If it is very much negative, take it towards stability until and unless you know that something big is coming your way or some big crises are coming in any particular countries. If that is so, then you need to incorporate that. Also, if there is a significant difference, you can find out and note that where is it coming from. If there is something big happening or something bad happening with particular country, then it would have disclosed it in notes as well. So you can find out where is it coming from and how will it stabilize. Also, after every quarterly earnings announcement, there is a call, analyst call, where companies management have a discussion with analyst or report the results to analyst, and analyst asks question. In that particular call, companies manage these, all these things are discussed, and companies management provide view for the future. So they will tell you that this difference came in from due to these reasons, these countries, we are expecting it to continue in future, or we are expecting it to be reduced in future, and so on.
Minutes of those calls recorded.
Yes, so that is reported. So in US, you can find out see it on Seeking Alpha, or the earnings transcript is reported on Seeking Alpha, and there are other agencies as well, or other financial media companies as well, which report the earnings transcript. So they put it in, transcribe it, and then issue it. For some companies, it is also issued on the company investor relation website, but on investor relation website, you wouldn't have questions and answers of analysts. For questions and answers of analysts, which is more important, you have to go to Seeking Alpha. बढ़ा दें से मतलब okay, so you have assumption sheet in which you have put in the CPI, you have put in macroeconomic assumptions, and then you have moved to you have forecasted the future volumes, FX impact. Once you have forecasted it all, some of these would be your sales growth, net sales growth. Okay, so that's so if you look into it, there are some regions for which I could find 5-year forecast, so I took it as it is. There are some regions for which I couldn't find it, so I had taken it as stable. This is the call that you have to make. Okay, now this part is pretty much sorted, which is net sales.